Hi, everybody. Thanks for tuning in and welcome to my Mortgage Escrow 101 class. So, we're going to go over briefly the content of the class, and of course, I'm going to explain it in detail thereafter. So, introduction, we're going to talk about what's an escrow account and why do you need it, how it's set up and calculated, the first adjustment and what to expect, how to proactively maintain from year to year, and what to do if you run into problems and some of the common problems that people run into. Okay. So, what is an escrow account and why do we need it? Definition: an escrow account is like a savings account that's held with the mortgage company, and it's designed to have money placed into it monthly by you so they could cover your taxes and the insurance at the end of the year or any other expenses that they deem will be an annual expense for your property. Uh, just for the record, HOA is not usually covered in your escrow account. It's a bill that you're going to have to pay on your own and pay attention to. So primarily, what can be in your escrow account is going to be, or is going to be your taxes and the insurance. Sometimes your taxes are not being paid to one entity for your property. In some cities, some counties, the school district is collected for with the city and all the other expenses, and sometimes they're not. So you may have up to two or three different tax bills that are paid annually. Also, your insurance. You may have multiple types of insurance depending on where your property is, or if you need flood, or if your wind and hail is separate from your fire policy. So you always have to pay attention as to how many different bills are being paid in total, because taxes and insurance may end up being up to 6 or 7 bills that are paid annually on your behalf. So why do banks like it and when can I cancel it? So banks like escrow accounts because they're designed to reduce the risk of you defaulting on your mortgage. So people will typically default on their mortgage if an event happens that keeps them financially from being able to continue making their home payments. So let's say hypothetically you're responsible for paying your own insurance, and for some financial reason or something happens and you forget to pay and the insurance policy cancels. And right when it cancels, you have an insurable event happen like a fire or um, a wind damage or anything like that. If that situation happens and you have to go into your pocket to make the repairs for your home because of course you don't have insurance, you're going to have to pay for it yourself. It may be an event that causes you to fall behind financially, which means you're not going to be able to pay. Because let's say something does happen to a house, hypothetically, a fire happens. Well, you can't really live in that house while it's being repaired. So now you have the added expense of having to find a place for you and your family to live while these repairs are happening. So if you have insurance, the insurance is going to cover all the most, if not all the repairs, less your deductible, and it may pay for your loss of use where it'll pay you for wherever you're going to live while these repairs are being done. So if that doesn't happen, let's say you don't have that coverage and you have to pay for all these things yourself, you may end up giving up and saying, you know what? Well, I can't afford to repair this house and live somewhere else. Turn it into the bank as is and kind of just, be on your way. And that can also happen if you fall also behind for your taxes from one year to the other, because most counties have the right to be able to go in and actually sell your property and foreclose on it if you don't pay your taxes for a long enough period of time. And it's kind of a bad hole for people to get into because you fall behind one year to the next, and now you owe a horrendous amount, and it becomes difficult dealing with. And not every county is flexible with how they let you pay that back. So to them, those are the events um, that the escrow account is designed to hedge the risk of. So as you start out this escrow account, it's designed to kind of keep you ahead of these expenses. And this way, if you fall behind on your payment in general, that there's enough money there that's available to take care of these expenses as they come. So there's no outside risk of losing your property to either to the county or to some kind of insurable event. So how it's set up, and this is kind of where most of this class is going to be spent because setting it up can be complicated and it can be simple depending on the situation and the property. Here's the reason why it's important and why sometimes mortgages are, you can make or break your transaction if you're buying a home because of this. So if as your loan officer, I am supposed to calculate this number correctly. I'm supposed to calculate correctly how much your escrow payment per month is going to be and how much your closing costs are. Depending on the property and depending on the kind of insurance and taxes that you have, is going to depend on how much you're going to pay for closing and how much your monthly payment's going to be. So if I underestimate when I pre-approve you for that property or when we start out your paperwork, then by the time it goes to underwriting and your property's underwritten with all the verifications of exactly what the taxes and insurance are, you may not qualify for the loan anymore. If I underestimate your escrow payment to say $300 a month and it turns out to be 600 or 700, you may not qualify for a loan for that size house at that price with that kind of an escrow payment. And conversely, if I overestimate it and I think you're really supposed to pay $600 a month when you are really supposed to pay only $300, then I'm going to overestimate your payment, which could lead us to believe in the very beginning you don't qualify for the property, or overestimate how much money you're going to be bringing to closing. Most of the time, what you're going to be bringing to closing, if you're needing an escrow account, is going to be your down payment plus your closing costs. Now, your closing costs are kind of built up of a few things: services that you'll need, and then your escrow account being set up. So the more accurate that we are, the better off you're going to be in the beginning, because we're not going to lose an opportunity on a property that you really qualify for. And at the same time, if you have like a personal budget in mind, because sometimes I can approve people for a dollar amount that's a lot higher than what they want for themselves. So if we start out with an inaccurate estimate of what that mortgage payment's going to be in total, then it can cause you to either give up on a property that that may have really fit your budget, or the opposite, that you get into something that you really can't afford, and then risking having your loan being denied. So the first part of how we are going to calculate this is going to be your insurance and the time of the year that you buy. So the idea is this: when you go to closing, so to figure out your monthly payment, I'm going to divide whatever your insurance bill is by 12. That's going to go into your expected monthly escrow payment. Now, what we're going to collect for in your closing cost is going to be 1 year's worth that you're going to pay up front, because you're going to pay for your insurance for 1 year at closing. And then we're going to collect about 3 months in advance. Sometimes I've seen banks do 2, but most of the time, let's expect to do 3. So now those 3 months in reserves plus the insurance is going to start affecting how much you're going to be bringing to closing. So let's say you buy this property in July. So in July, you're going to be paying taxes. You're going to be paying for the insurance for 1 year, and your policy is going to renew on July of the next year. So when it comes to your taxes are going to be typically due at the end of the year, that need to be paid up until January. Most mortgage companies will pay it in December. Sometimes they'll tip over into January, but you typically won't be penalized because they get a bill just like you do. So when you're closing, let's say in July, what we're going to presume is we're going to want your escrow account to be started with taxes to cover the month you're in plus 3. So if I'm in July, I want 7 months worth of taxes built into your escrow, and then I want to add 3 months of that as a cushion. Now, the difference between your insurance and your taxes is that your insurance is due right away, right? You start that policy right when you close. We're starting to collect for your taxes, and they're not going to be due for a couple more months if you're buying towards the end of the year. If you're buying towards the beginning of the year, we would collect less. The idea is when I'm setting up that escrow account, I'm going to be getting a credit from the seller for your taxes that's going to cover the initial part of that escrow, because of course they own the property from January 1st to the time that you're closing. So your credit for taxes from them should cover what you're putting in initially. So that's the timing of how they're different, because one's due right away and will renew on the anniversary of the month. And then the other one is going to be at the end of that year. And depending on how close you buy towards the end of the year is going to depend on how much that we're going to collect. So now to speak of how much money you're going to collect, we have to take a look at the exemptions that you're going to have versus what is already on the property. So let's say you're buying a property that you're going to live in. So we may presume that it's going to be your primary residence and we're getting a loan as a primary mortgage. So we know that your overall tax bill, you're going to get about a 15 to 20% discount off the raw bill because it's going to be your homestead. Okay. So let's say you're buying it from somebody who also has it as their homestead. Well, then they should hypothetically be taxed the same as you. So when they give you a tax credit from January 1st until July, that should match your escrow, how much we're going to collect. And you're only really putting in an extra 3 months. But sometimes what the current and future tax assessed value is going to be different. Because let's say the person that you're buying the property from, let's say they don't have a tax exemption and maybe it was their investment property. Well, they're going to have to actually give you a credit that's a little higher than what we're going to be collecting on your behalf because they weren't exempt from 15 to 20% of the taxes because of a homestead exemption. So it is very possible that the county could prorate it and say, well, look, you owe us, we're owed this much for this part of the year. And then when you put on your homestead exemption, this is how much you're going to owe from this point later on. But what typically happens with the county is they don't, you have to pay attention to what they're doing because sometimes they'll prorate the whole year. Sometimes they'll give you credit for the whole year. So it's something to really watch out for, at least to make sure you collect what you need to collect from the seller, because it's going to be a problem if you close and you don't bring this issue up to try to get money from the seller later to cover a shortage or a surplus for taxes that you should have gotten at closing, right? And so another example of how you could run into an issue is, let's say you're buying a property that was owned by somebody who's over the age of 65. Well, in Harris County, Texas, when somebody owns a property and they turn 65 and they apply for an over 65 exemption, and let's say hypothetically it's also their homestead, what will happen is the county will stop increasing the assessed value of that property the minute they turn 65. So let's say hypothetically somebody bought a property when they turned and they owned it for a while, and when they turned 65, they placed this exemption and it was worth $100,000 for tax purposes. Okay, so let's say, fast forward so many years and now they're, 20 years later and now they're 85. And for whatever reason, they're selling it, their heirs are selling it, or somebody else is selling it with that exemption. So now their tax bill technically will be next to nothing, maybe $200-300 a year for that property. But your tax bill is not going to be the same. So one of the things that we have to watch out for, myself as your lender, I have to watch out for as well as you, is that the property is going to be unfrozen. So as the assessed value is frozen because that person is over 65, the market value, what they think the property is really worth out on the market, will change from year to year. So that's something that you're going to watch out for on your tax bill, is you're going to have an assessed value and you're going to have a market value. The assessed value is legally what they can tax you on, depending on the kind of exemption you have. And the market value is going to be what they think your house is like in the market. So now let's say you're buying this property from them, from someone who's had an over 65 exemption on it, and they're not giving you that credit. You also have to take into consideration that the county is going to unlock that value and they're going to tax you on market for the first year that you have it. This is assuming, of course, and this could be for anybody, whether you're over 65 or you're not over 65. Because let's say you're over 65 and you're buying this property, they're going to unlock the value, and let's say they're assessing it now at 250 versus 100. You're going to start paying that tax rate at 250, but all your other exemptions are going to apply. But it's just going to start out at 250 versus 100 when the previous owner had turned 65. If you're not, let's say you're not over 65 and you're just getting a homestead exemption, we're going to have to look at what the rate is going to be, less the exemptions for being a homestead, at the market value of the time that you buy it. So that calculation could be done by your lender, and we tell you, and this is something that's important for us to check and do in the beginning. to make sure that your taxes are actually going to be that they're going to match, that they're going to be legitimate, and that there's not going to be any surprises. Now, if we don't pay attention and we just take whatever numbers and we start out your loan, by the time that your loan goes to be underwritten by an underwriter, they're going to have the tax certificate, and the tax certificate will show that the property is going to be unfrozen. So, the reason you want to pay attention to the exemptions that are currently on the property to see that they're going to be the same as your exemption is because you want to make sure to know if you're going to be expecting or getting a tax credit from the seller that's going to cover what you have to deposit into your escrow. Because if not, you're going to actually pay an amount that's a lot larger than you typically would just to be on the safe side. Because most banks aren't going to let you say, well, okay, let's prorate it to the T. They're just going to presume that the whole year is going to be taxed at your tax rate, and you're just not going to get a credit from anybody to offset it. So we always have to ask, and we also have to go into detail to figure out, you know, what could be done because we want to make sure we're getting all the money that we need. All right, so tax credit to the buyer and aggregate adjustment. So, like we said earlier, that tax credit is important because it makes a difference as to how much you're going to be paying at closing versus what your monthly payment is going to be. So, let's say hypothetically you're buying closer towards the end of the year, you're buying in October, November, and the tax credit and your aggregate adjustment, here's how they're going to come into play. So, an aggregate adjustment is an estimate that's done by the bank when calculating your escrow to figure out if at any point in time it's going to be overfunded. And if we estimate that it's going to be overfunded, then you're going to have an aggregate adjustment of a negative dollar amount to bring down the overall amount that's needed for you to qualify, or actually for the property to qualify. So now let's say we're at the end of the year. For some reason, mathematically, as we get closer to the end of the year, the aggregate adjustment becomes higher and higher. So let's say you're buying a property and your goal was to buy it and pay your down payment, and you negotiated seller concessions in order to cover all your expenses, and you're hoping to pay, maybe 3.5% down on your FHA transaction, and that's it. So now that aggregate adjustment at the end of the year, assuming everything else was calculated correctly, and let's say you're getting $7, $8, $9,000 from that seller to pay for your closing costs. If at the end when we're closing at the title company and the closing disclosure is prepared, it may show that you're getting too much money from the seller because of this adjustment. And then the first thing everybody wants to do is just cut the seller concessions, which isn't fair to you because you negotiated those seller concessions, which affected your price, right? Because if you didn't ask for as much concessions, it's very possible that you could have bought the house for cheaper, ergo cheaper payment, cheaper interest over the life of the loan. So we really don't want to give back anything to the seller when it comes to having a tax credit that's, so we can make sure we get the right amount of credits for their taxes for everything. So, for example, FHA has a rule. FHA requires that you have 3.5% down payment into your property. But when you get to closing, how does that 3.5% calculated? Well, it's going to be first credit you're going to get is for your earnest money. So if you verify your earnest money throughout the process, which most of the time you will, that's going to be reduced from your 3.5% that you're required to bring at minimum. Then the next thing that's going to be looked at is your tax credit. So because you're at the end of the year, that seller may be giving you almost the whole bill, as a credit. So that can kind of be used towards your down payment to meet your minimum 3.5% requirement. And then you also have whatever closing costs that you're supposed to pay. Ideally, your escrow account is going to be high enough where it's going to consume that entire bill. But because your aggregate adjustment is going to be so high, it's going to make it look like the seller's paying too much in concessions for you. So you have to know the rule and be able to do the math as you're buying that property. And this is something your lender is supposed to help you out with, where if we know we're closing in October, November, or December, as we get towards the end of the year, so let's say hypothetically we're in October, and the reason being is the tax bills aren't out yet, hypothetically. I want to make sure that my loan is set up where I can take benefit of that aggregate adjustment, the taxes, that tax credit being used towards my minimum down payment requirement, and my closing costs that I'm getting from the seller. Now the rule is, let's say hypothetically, we get everything done, and you're really only bringing 1% down because you're getting so much from the seller. You can do that so long as the other 2.5% is in your bank account. So you can apply everything towards your minimum 3.5% requirement, so long as you have it in assets. If you don't, then you can't apply it. So that's the important part of making sure that your tax credit um, is accurate and you understand how much that aggregate adjustment is going to be as the time passes. Now, in the beginning of the year, you really don't have this issue. So, one of the things that helps out is, let's say you're buying that property in early November. So, at that point, the tax bills are already out. So, most title companies, if the tax bill is out, and not just one bill, but all bills, they'll actually collect the money from the seller and pay for it, which can alleviate the problem of having to overestimate your cash to close, because now we're not going to be so negative and it's being paid for. It also helps you out if you're buying a property that's owned by someone who's over 65 or by a builder, because if the bill comes out, we're not over collecting from you because we're expecting to have a shortage, because they're actually paying the bill for the actual amount. And so it's important to pay attention what time of the year you're buying what property, and to be able to have all this math done in advance so you can qualify for the property that you want and not let go of a property that you think is too expensive that may really have fit your budget and your qualification.